Welcome to the Lenders Digest podcast, hosted by Jonathan Preston. Please subscribe to the newsletter lendersdigest.substack.com. So in today's episode, I want to talk about some entry-level property development projects that can be done using normal mortgages and how this works. So earlier this year, I actually did a property development course at the Sydney Community College with a developer and buyer's agent called Richard Williams. And so he develops properties himself mainly around the Newcastle area and recently did an NDIS development. And so we discussed some scenarios, and he advised that as his first development, he suggests actually buying a house on a large block and simply adding a second house on the back. And that way it's low risk, but you're also adding a lot of value in terms of that second property. And so I think that this makes sense. And in future years, I will consider more value add plays for myself. But I did want to discuss in a bit more detail today about how these can be financed, because finance for developments is quite a complex topic. So the part I want to mainly focus on today are the type of developments that you can actually do with normal residential lending. And I think this is important because normal residential mortgage rates are about as good as you're going to get when it comes to developing. And that's because this is typically a high risk activity. So interest rates are often higher for developers who want to borrow money. Now, when it comes to construction, typically you can build a duplex, or in some cases up to 3 properties, still under residential policy. It seems to be that when you actually hit 4 properties being constructed, it hits a bit of a wall in terms of being accepted by lenders in residential, and lenders typically want to take it as then a commercial property with lower LVRs and other rules. So for example, when constructing 4 or more, you're probably going to be more like at a 65% commercial LVR versus say an 80% LVR if you were to stay in normal residential policy. So in terms of some options here, you've got the option around potentially buying a home, potentially renovating it and then flipping it. And that's kind of the standard classic sort of home renovator, buy and flip. People often buy homes, to live in so that they get owner occupied interest rates, and then they live in the house while renovating it, and then they flip it. And this is attractive both from the perspective of an interest rate, also the loan to value ratio, but also from a tax standpoint. You need to seek an accountant's advice, but people may be exempt from capital gains tax as their principal place of residence if they're living there while they're doing the work. So that's, the traditional one that you see on, The Block and all the sort of TV shows that we have here. The next level up from that is where it's still generally considered residential, but you might be looking at, say, investor interest rates, and that's where you're, say, building a duplex. So you're effectively turning 1 property into 2. This is where you are adding a lot of value, and you are really changing the asset entirely, going from 1 house to 2. But because it's only 2 properties still, a lot of lenders will still take this within standard residential lending. So that again takes it up another level in terms of now you're doing construction of 2 properties. So there is quite a lot of value add here comparing it to just the 1 house that you'd be starting with. Now, the third level up, that's where you'd potentially look at constructing, say, 3 townhouses. So the traditional, maybe you're buying a big house, old big block that's ready to be knocked down and put 3 townhouses in its place. This is increasingly popular, especially in Melbourne. Generally, if you were to do that still in residential policy, you'd be able to go up to, say, an 80% LVR lend in a lot of locations at prime bank rates. But it's when you would get to, say, that 4th property, that's when it's going to go into commercial, potentially more rules, lower loan to value ratios and that kind of thing. So I do actually know someone who does developments a bit similar to what I just described, generally subdivisions and construction. But because they're normally 3 or less units per development, they're able to do it under residential lending policy, which means rates stay sharp and the loan to value ratio is typically 80%. And so it's also important to note that your margins are going to be affected by the holding costs. So by keeping your holding costs low, you're actually able to compete for more projects because you'll have an economic advantage over your opponents. Now, I haven't actually yet done a development myself. I've been an all buy and hold investor, but I have financed a number of projects over the years. And if you are looking to get started in this space, I'd love to work with you on this, as it is something that I'm expanding my knowledge on, and I'm keen to get into this space myself eventually. Also, if you are keen for my help, please reach out to me on LinkedIn by searching Jonathan Preston Mortgage Broker up and mention that you listened to the episode. I'll then get back to you to book in a call and we can discuss further. And if you did enjoy the episode, please follow me on whichever platform you're on. And if you would consider leaving a 5-star review, it means a lot to me. Thank you again for tuning in.